Hi guys, welcome to my channel. Imagine Microsoft need 500,000 millions for the few months. It doesn't want to issue a 10-year bond. It doesn't need a long-term loan. It simply needs short-term cash. So here the questions. Can a corporation borrow hundreds of millions of dollars without pledging specific asset as collateral? Yes, that's exactly what commercial paper allow highly creditworthy corporations to do. But there's a catch. Commercial paper is unsecured. There is no specific asset backing the debt. So why would investors be willing to lend money without collateral? Because only companies with very strong credit quality can normally access this market. Today we will see how commercial paper works, why its use is slightly above treasury bill, and why credit quality is the key to understand the instrument. Let's start with the basic idea. Commercial papers is a short-term debt instrument issued by a large corporations and banks. The company needs money today, an investor provides the money. The company promises to repay according to the term of the instruments. But there's one word you absolutely need to remember: unsecured. That means the debt is not backed by a specific asset. If a company issues a secure bond, it might pledge particular asset as collateral. Commercial paper doesn't work that way. The investor is essentially relying on the creditworthiness of the issuer, and that's why the commercial paper market is dominated by large, financially strong companies. This is where the economics become interesting. Suppose two companies want to borrow money. Company A is one of the world's largest corporations with a very strong balance sheet. Company B is a small, highly leveraged company with uncertain cash flow. Would investors charge them the same interest rates? Of course not. Company B represents greater default risk, so investors demand higher returns. This is the basic relationship. Higher perceived credit risk, higher required yield. Commercial paper make this relationship very clear. Because the instrument is unsecured, investors need confidence that the issuer will repay. That's why commercial paper is generally issued by corporations with strong credit quality and established reputations. Now let's connect these two interest rates. Commercial paper generally offer a yield that is higher than government or Canada Treasury bill, but lower than many other corporate fixed income securities. Because we are moving along the risk spectrums, a government treasury bill is generally viewed as having extremely low default risk. A commercial paper issuer is a corporation. Even a very strong corporation has some possibility of financial distress. So investors demand a little more compensations. But commercial papers is still very short terms, and issuers are generally highly creditworthy that keep the required yield relatively low compared with riskier or longer-term corporate debt. Think of the yield as the market price for taking risks. Another important feature is how commercial paper is issued. Most of it is issued on discount basis. This is similar to the treasury bill structure we discussed earlier. Instead of paying regular coupon interest, the investor purchases the instrument for less than its face value. The difference represents the investor return. For example, imagine a company issue commercial paper with a face value of $1 million. An investor might pay slightly less than $1 million today. At maturity, the investor receives $1 million. The difference is effectively the interest earned. This is why commercial paper fits naturally into the money market. Short maturity, high quality issuer, and typically a discount structure. The commercial paper is designed for institutional scale short-term financings. The minimum denominations is typically $50,000. Maturities can range from as little as 1 day to 365 days. So this isn't primarily a product designed for someone investing a few $100 in a wholesale financial market. Bank, corporations, and institutional investors are more important. That tell us something about the role of commercial paper. It is fundamentally a mechanism for moving large amounts of short-term capital between sophisticated market participants. There is another instrument closely related to commercial paper, finance paper. Finance company, particularly sale finance company, issue short-term promissory notes to raise funds. The structure is similar. Each short-term debt is generally issued on this basis, and the denominations are typically large. The main distinctions to remember is the issuer. Commercial paper is issued by large corporations and banks. Finance paper is associated with finance company that need short-term funding. For CPA purpose, focus on the economic functions rather than getting lost in the terminologies. Both are mechanisms for short-term borrowing in the money market. This comparison is extremely important. Let's put commercial paper next to treasury bill. A treasury bill is issued by the government. Commercial paper is issued by corporations or banks. Treasury bill has extremely low default risk. Commercial paper carries some corporate credit risk. Therefore, investors generally require a somewhat higher yield on commercial paper, but note something important. Commercial paper doesn't necessarily have a high yield. It is still short-term debt from highly creditworthy issuers, so the spread over treasury bills can be relatively small. This is a classic risk-return relationship. The market is saying, I will lend to these corporations, but because there is more credit risk than the government, I want a little additional compensations. From the company's perspective, commercial papers is a financial tool. From the investor perspective, it's an investment. This is the fundamental role of financial market we discussed earlier, connecting surplus funds with funding needs. Corporations may have temporary financing requirements. An institutional investor may have temporary easy cash. Commercial paper connect the two, and because the maturity is short, both sides can manage the balance sheet more precisely. The company doesn't need to commit to 10 or 20 years of borrowing. The investor doesn't need to commit capital for 10 or 20 years either. That's the beauty of the money market. It allows capital to move efficiently over short horizons.